Everyone, and thanks so much for joining us for this month's State of Freight webinar. My name is Marianne Hensley. I'm the Vice President of Content Marketing and Media Operations for FreightWaves, and I'll be your host for today's session. As always, I'm joined live here in Freight Alley by our founder and CEO, Craig Fuller, and Head of Freight Market Intelligence, Zach Strickland, and we're proud to present today's webinar in partnership with our friends at Prologis. In our conversation, we'll discuss the latest industry trends, including the unseasonable demand pattern we've been seeing this summer, based on critical insights from our Sonar platform. Craig and Zach will also be able to answer your questions live following our discussion. And before we get started, just a couple of quick items. First, if you have any issues during the webinar, you can reach out to our team via the audience chat function in your webinar console. And if you have questions that you would like to ask our experts, you can enter those through the Q&A box in your console at any point during the conversation today, and we'll answer as many of those as possible during the live Q&A. We'll also be sending a link to the recording of this webinar tomorrow in case you'd like to view it on demand or share it with your colleagues. And at this point, I will go ahead and turn it over to Zach and Craig to kick us off.
Thank you for that, Marianne, and thank you all for joining us today for this special edition webinar, Craig. I feel a little underdressed with you here in the suit, but you know what? It's fine. I'm going to be...
You are underdressed. It is special because we have a live studio audience.
Yeah.
So this is the first of going to be a regular thing for us here at the State of Freight. We're actually now inviting the public to come into Freight Alley here in Chattanooga, Tennessee, and be a part of the audience that does the State of Freight. And we're actually going to open up at the end for questions of folks that have an opportunity to ask questions live. So this is a different experience. We'll see how it works out, but I'm excited about it.
Yeah, well, that being said, live studio audience and all have some energy here today, but I think we need to dive in to the State of Freight. So we've got this anomalous environment with the tender volumes. If anybody that's read FreightWaves.com, keeps up with it, is a Sonar subscriber, obviously, you know that there is a very weird pattern in freight going on right now. We've had an uptick in OTVI, which is the tender volume index. It measures the total tenders going from shipper to carrier, and it's an indication of freight demand, total freight demand. It never increases in July, outside of July of 2020. We never see this.
It is Christmas in July for truckers. But the weird part about it, it doesn't feel that way.
Right.
So this is the Christmas that didn't have snow. It feels weird. The reason I say that is, can we pull this chart up real quick?
Yeah.
I want to show it because I think it's really, really important. So if you see that white line, that is the 2023 numbers. Mm-hmm. And that white line is breaking out from seasonal norms. And it's hard to, the problem with the COVID economy is for folks that have sort of studied these patterns, we kind of know it if you've been in the industry for, say, a couple decades. If you haven't been in the industry very long, this is hard to read this chart and sort of draw any conclusions out of it. But I will say, if you go back historically, July is a pretty soft market. There's a couple things that happened in July. Auto manufacturers shut down for retooling. They create their new assembly line. People take off for July 4th. There's less trucks in dispatch. The back-to-school stuff has already moved into distribution centers really in the second quarter. So really, it's a month where most people take off. This year has not happened, and it's telling us that something is different about this freight economy than what we have seen over the last couple quarters.
Yeah, and to your point, this demand, it's almost invisible in the way that capacity is still not.
It feels invisible because the carriers are not benefiting from it, and we know they're not benefiting from it from the tender rejection data.
Let's pull up the OTRI.
If you look at the tender rejection data, it's showing tender rejections, again, just for the audience's benefit. The tender rejection data tells us the number of transactions that are rejected, and remember, 0 to 100% of transactions rejected. Why do trucking companies reject freight? Because it's not in a proper lane, it's out of network. They basically reject freight when they have better options to do with the capacity. They tend to accept everything, and when we see acceptance rates, or rejection rates, I should say, in the 3.5%, or acceptance rates at 96.5%, inverse of that, then you're in a situation where trucking companies are taking everything they get their hands on. And that's what they're doing in a market that actually looks like it's breaking out. So I ask you, Jack, why is the freight market breaking out? What is this data telling us, in your opinion, about why the freight market's breaking out and is showing some sort of anti-seasonal norms?
Yeah, I think we're still adjusting to this world after COVID. I think we had this huge bubble created by the COVID environment where everybody went out and bought a bunch of stuff. Then we heard this narrative about inventory reduction. Target, Walmart, they all had to get their inventories under control. So one of the theories here is that inventories have corrected to an extent.
Do we have any data to support that?
We do. We have the LMI, but I don't have that chart. But the LMI does tell us a value of a 41.6 last in July. That tells us anything below 50 is a contraction.
So it's a diffusion index,
Yes.
which is anything below 50 means that whatever it's measuring is sort of worse off. It's a survey. It's based on opinion. So in a diffusion index below 50, a PMI is a diffusion index, basically means that people are less bullish, or whatever that factor is, or less whatever,
Well, there are initiatives to draw down inventory.
So so what this is telling you is it's drawing down inventory.
But it's drawing it down at the fastest pace in history of the LMI, which started in 2016.
There's a reason perhaps that's the case. If you think about the freight cycle, and you think about the fact that companies plan their businesses out a year, we think about when the trucking market collapsed, if you recall, was March of 2022 when we came out and said, hey, the freight's in a recession. That was sort of the start of the cycle, sort of peak, sort of the downward pressure on the market. We are now 15, 16 months into that. Ocean market collapsed last June, was sort of the May of 2022 was the peak. So if you're thinking about it from a retail perspective, you don't want to carry inventory very long.
Right.
They probably carried it longer than they would have normally carried it because A, they had so much of it, and B, the types of items and products that they were carrying in inventory were high dollar discretionary, TVs as an example, furniture, stuff that has a high dollar that you're simply not going to liquidate.
Right.
But we've gone through a period of at least 12 months where they've liquidated it, and it's quite possible that the market is now catching up to that reality.
Yeah, and I have two charts. I have two data points here that support the fact that we are seeing kind of this return of ordering coming through.
You mean a more normal non-COVID cycle?
Correct, a non-COVID cycle, but also one that's a little bit early for what we would normally see. Let's pull up the LOTVI here. So this is a chart that measures the tender volume index based on the various lengths of haul. Now, long haul freight has been growing.
And that's that L.
That's the
right?
L, yeah. It's the LOTVI. So this is freight that moves longer than 800 miles. This chart right here, the only length of haul that has grown from a year-over-year perspective is the long haul tender volume index. And you can see it there on the white, that white line. It's a huge mountain. And it's basically a little early for long haul freight demand to do this.
It could be inventory replenishment. There's something also as a backdrop. Think about what's happening in China. The Chinese economy, last year at F3, we had the gentleman, the CEO of China Beige Book, which does, where China is such an opaque market in terms of data. He actually runs a business that goes out and interviews business owners in China. Because we can't trust government statistics. By the way, they've cut off a lot of their official statistics because they're so bad right now, but that's aside. What he told us point blank was when the economy reopened, there isn't enough confidence among business owners to go out and spend because they don't trust it. The government has not done themselves any favor. They also have some demographic challenges. So the fact that we've seen China really slow down significantly is a factor that may be important to know. And the reason I say that is we've talked about inflation, and we've talked about all of the additional cost increases that companies have had to pass on to consumers. We know from the Federal Reserve's data, as well as just the broader data on cost and inputs, is that those are coming down. But if you're seeing a slowdown globally and it's impacting Chinese demand, export demand, those companies are cutting prices to American retailers. And in that process, if you're a retailer, then you're able to order more, you're able to have more planning time, the cost of freight is a lot less, you're able to take time. And I think that may be driving some of this inventory replenishment. There's one more data point that we should point out. If you look at intermodal data, the intermodal data has broken out of that seasonal norms. You talk about long haul, intermodal's reacting on the same fundamental development.
Yeah, let's pull up the O-rail, the outbound loaded rail container volumes here. And you can see a similar pattern of a kind of this ramping. We're talking about loaded container volumes moving on rail. This is both 40 and 20 foot container volume. So the big stuff, the small stuff, also the 53 footers are also on this as well.
And it's one more thing is, Henry Byers has come out, our ocean analyst, who watches the Chinese data and the global trade data, came out and pointed out that this was going to be an early peak season.
Yeah.
And we've seen that the ocean market is still soft, but it's actually doing better. It's sort of performing at more seasonal norms. It is quite possible that retailers, in an effort they burned down their inventory in an effort to get ahead of it with lower costs, took advantage of some of the cost concessions, and went ahead and moved freight into sort of forward positioned freight across the landscape. So that could be explaining it, but I don't think that's the entire answer. I think what we're also seeing is the impact of the Inventory Reduction Act. We're now a year into
Inflation.
the process. Did I say Inventory Reduction
Inventory,
Act?
yeah.
Every retailer
already-
has an Inventory Reduction Act. Inflation Reduction Act, which is a funny name in itself because it's neither. Anyways, I won't go there.
No.
But
show.
But the fact is that we saw government stimulus between the Inflation Reduction Act, the infrastructure bill, now it's 2 years. And one of the things to keep in mind is, if you go back to the COVID economy, what drove a lot of consumer demand was all of the stimulus that the government gave consumers. Business owners with PPP, all the government stimulus. Consumers have a really quick desire to spend that money. And that's what drove a lot of the excess consumer spending. The money going into in terms of these big other infrastructure acts and the Inflation Reduction Act, that stuff takes a long time to filter through the economy. Some of it's tax rebates based, some of it has other impacts. But really, at the end of the day, if I give a lot of it went to states and municipalities. If I give that money to a government official and to a state municipality, it takes a while for them to allocate those funds. They do RFPs, they do permitting. If you've ever dealt with a local or state government for anything, rezoning,
Years.
you know it can take months, quarters, years, in some cases a decade or two in some of these things. And so it just takes a long time for that money to filter through, these projects to start. And I think what we're seeing is the very early stages of some of that money filtering through. There's a recent chart about manufacturing nearshoring, which is the concept of moving manufacturing not just back to the United States, but also to places like Canada and Mexico. Could even go further south into Latin America. And what we're seeing is that the amount of nearshoring projects is up something like 500% in the last 12 months. And so a lot of that is suggesting that there's also this manufacturing movement back to the United States. But let's be frank, you cannot move all your inventory and build a production plant in 12 months. That takes a long time. And that may be why some of this data is quite confusing and breaking out of this normal seasonal norms. There's also a couple other factors I want to touch on. One is beverages. It's really freaking hot right now. Beverages move anywhere from 5 to 8% of freight, depending on how you calculate it, depending on what season it is. They see things like, it seems insane, but it's things like Coca-Cola, it's PepsiCo, it's water, it's beer. That stuff moves and is directly correlated to the temperature.
Right.
So we could be seeing some additional effects of just a really hot season that's also driving this. In fact, we were looking at some data not too long ago out of Phoenix, Arizona. And do you know what Phoenix, Arizona does in terms of freight? What the commodity that moves out of Phoenix? Gatorade.
Oh, yeah.
Like,
well,
it is a
also in
huge,
Texas. Yeah.
well, but it's a huge commodity out of that area. And so you can see some freight just pumping because of sort of back to school and sort of back to this sort of sports drink environment.
Well, and Phoenix has been a growth market.
It has been a massively
Like the desert is being developed, like at a massive pace.
and to the concern of all the water and urban planning people, it is really developing. But you're right, like people have moved out of California. A lot of sort of call it industrial economy focused businesses have moved out of California and have moved into Arizona. And Arizona has become a real hot place to, in the old days, nothing moved out of Arizona.
Right.
It all just moved in and died. Like freight moved in and that was the end of the line for them. They're deadhead to California. But it's no longer the case. Now Arizona, because of its distribution centers and some they won some recent manufacturing plants, have become a pretty big source of outbound freight.
Right, and I think the tender volumes for Phoenix, I don't have this chart, I wish I did, have almost tripled since the outbound volumes have tripled since the summer of 2019.
Yeah, it's a big growing market, but a lot of it's staged. There is some manufacturing, but I think we would be sort of oversubscribed manufacturing to it. A lot of it's just staged freight that came off the ports. Remember, at one point last year, and this is sort of early last year, there was a point where there was zero warehouse space. You know, our sponsor, Prologis, can appreciate this because they know it better than anybody. There was zero freight or available storage, warehouse available space in Southern California. You had to move it to Arizona and put it on rail and get it out of the state of California because there was actually no place for it. That has subsided to a degree, but that freight is still staged in Arizona and still producing.
Yeah, it's the new Inland Empire.
For sure. And the Inland Empire is that part, for those that don't know it, it's that part of Southern California that is further east of LA, sort of outside of the San Bernardino, Fontana, Colton. That's the area where it is. It's almost out to Palm Springs. I mean,
and the volumes out of Ontario are down, I think,
Desert.
roughly like 2 to 3%. I mean, it's not a huge drop, but
no,
for that
but
market.
It's just because California has continued through rezoning and CARB and all the regulations, and just lack of space and cost. A lot of that stuff's moved to places like Arizona.
It's significantly more expensive to operate out of California.
Absolutely. But Arizona's now catching up. I mean, they you know, it has become, it's still a vibrant economy, but some of the restrictions they're putting on development due to water shortages is going to impact the cost of moving production to Arizona. So
how viable, I mean, we've seen the Phoenix market grow. We've also seen Laredo, the border crossing markets grow.
Man, let's talk about some Texas.
Yeah.
Like, I'm excited about what's happening in Laredo.
Yeah, the Laredo market has also been one of those big growth markets. It's grown, I believe, by a factor of about 3 or 4 as well, 3 or 4x versus 2019 levels. And just like Phoenix, we've seen this ramping activity out of the Laredo market.
And it has not been playing into seasonal norms.
Right.
Or even been playing, into seasonal norms. It's certainly not playing into seasonal norms, but hasn't been facing the cyclicality that we've seen in the rest of the market.
Right.
Laredo has been an incredibly bullish market, and it's largely because of this nearshoring factor that we have talked about. You know, it's interesting, that's sort of the reason I'm so excited to talk about Laredo is I went to school at Baylor University and I got there in 1997. NAFTA was passed in 1994. And if in that part of Central Texas, which is, Waco's in, 2 hours south of Dallas, it's about 2 hours north of Austin, it's right in the center of Central Texas. The whole belief was, in all these classes I took for 4 years, is that NAFTA was going to completely reshape the Texas economy. But something happened in 2001 that really took the NAFTA factor away as a big growth element for the state of Texas. And that was China's introduction to the WTO. When that took into place, I think it actually went into effect in 2003. It was 2001, 2003 period when it actually sort of fully embedded. That really changed manufacturing from sort of Mexico-oriented to California.
Right.
It's sort of like the old days when you think about from a perspective of when I was in freight, Walmart was growing really aggressively and everybody was like, oh my gosh, Walmart's gonna take over the world. Now people feel that same about Amazon and Walmart's like the friend. People are like, oh, Walmart's the lesser of two evils in some ways. And I think it's the same thing happened where China, years ago when I was in college, it felt like Mexico was gonna take Americans' jobs, a big backlash towards Mexico.
Right.
That then moved to China, and I think Americans are now more willing and welcoming of that Mexico trade. That's sort of bringing back that NAFTA environment.
Yeah, I agree with that. I want to pull up a chart here, though. IOTI, I want to challenge this concept of nearshoring having a big impact. The IOTI, if you will, which is the Inbound Ocean TEUs Container Volume Index, it measures the total 20-foot equivalents that are being booked on boats that are heading into the United States. And the white line, it's
You're going to get hate mail with calling it boat.
the big boats.
I get hate mail for calling it a boat.
Yeah, I know there's a little bit of a contention around the name boats. Wow, what a world we live in. So the white line there has become a little obscured. The current year is now almost overlapping. We saw this spike in the early part of July, and we were thinking, okay, and Henry Byers, like you said, wrote this article about the early peak season. And I think we're still in this early peak season, which is early relative to the COVID peak season that we saw that started in like late August and ran through September and really was almost year round during COVID.
I think but even before that, peak season typically ran on a sort of, for ocean, July, August, September.
It was kind of a later peak during COVID to an extent.
It was, but it sort of ramped up into, you had Golden Week?
Yeah, Golden Week was kind of this next
It moves around the
wave.
calendar, but second week of October is a good
Well, it looks like here we had this, it peaked up in July, and it's like, okay, this is the typical July maritime thing, and now it's back up in August. Again, not out of what I think historical peak would be
I
considered.
think the market's just telling you on the ocean container side is it's performing the way it sort of normally does. And I think what's happened is I'm no longer, if I'm an importer or a BCO, I'm no longer waiting 6 months to get hands on product. I'm able to turn them over more normal cycles. One of the things of the data that I think is really interesting was there was this big conversation last year when Henry Byers wrote his article about ocean market. Is a lot of the people that were contradicting Henry's data were looking at total freight bills of lading, not the TEUs. We have built this data science model that goes out and breaks up the number of TEUs. And everyone was looking at the bill of ladings. The bill of lading data didn't change that dramatically.
Yeah, because you could have 1 TEU or you can have 30 TEUs.
Exactly. And one of the things that's really interesting, I wish we had the chart, is you could see a break between the number of bills of lading and the number of TEUs. What you were getting was a relative small increase in the numbers of bills. It was up, I think, 11%, if my memory is certainly correct. But the number of TEUs was up something like 40%.
Yeah.
And a lot of what I sort of derive from that is that if you're a small importer, even in the COVID economy where demand's high, you don't have the capacity to order 2 or 3 or 4 TEUs per unit. What I actually think was happening was it was the big box retailers that were driving the predominance of that container demand to fill up the stores. Remember, 75% of container freight is consumer, ultimately internet retail based. And so I think what was happening is it was the big, huge importers were driving the predominance of freight demand. It was breaking all of the models that had been built on these BOL sort of forecasting models. And what it was actually happening was the number of TEUs was just exponentially increasing versus the number of bills. And I think that's where a lot of the argument, looking at the data, came in last year, where a lot of folks could not comprehend the collapse in ocean volumes simply because they were looking at the bill of lading and be like, well, it's not that big in terms of the increase. But they didn't actually look at the number of boxes that happened to be on the ships. And I think what we saw was, or what we're seeing now, is that some of those importers, some of those big box retailers are taking advantage of some of the lower cost and bringing in inventory that's firming up a little bit of the ocean market. And they have so much inventory that's out there. I remember I went to a conference in San Diego, California. I spoke at a conference. It was last September, October. It was sometime in the fall. And I remember there was a couple of ships out there, container ships, and they were just filled with Amazon boxes off the shore. And I asked the person there, how long have they been there? They said they've been there weeks. Literally, Amazon had ordered so much freight, and because there was no storage, they were just parking it out on ships off the coast. And I think what's happening now is all that freight sort of cycled through. We burned down a lot of that inventory. Amazon's doing a second Prime Day. I don't know if you've caught that in October. They usually do 1, they're doing 2, because they're trying to get ahead of this holiday season and to continue to liquidate and drive some of these sales. I don't think it's by coincidence they're doing it in the middle of early in the fourth quarter. And I think that's what we're seeing. So we're seeing this inventory burn down combined with government stimulus that's driving it. And I think this is sort of some interesting anomalies. I do want to just sort of change pace a bit to talk specifically about retail.
That's where I was going next.
I love
we were on the same page.
You had that smile of like, I got
like,
something.
This is it. This is it. So I want to pull up the daily truck visits.
So this is a new index. It's interesting. We had the ocean container IOTI data for some time.
Yep.
We have had this truck visit data. We've been actually building these models for 6 years, 7 years. Really one of the first data sets we ever had. But we were always cautious to go publish it because we needed to have really sophisticated data models, particularly when you're talking about very specific retail. It's very easy to build data models on macro level data because the data is very transparent. When you get into specific companies, you have to be very careful about that. But we're at a point where the models and the algorithms are perfected enough where we feel very comfortable to go public. Last Friday, I got the chance to talk about this on Bloomberg and CNBC about what we were seeing in the data. And so you sound like you want to dive into it.
Yeah, I want to set you up.
All right.
So let me set you up. So first I want to introduce everybody to this chart, which is basically, it's a percent change year over year in total truck visits for these various companies. The one in white there, Amazon, the single only one that's showing up at the end of the chart. Now I know Costco, they're in fuchsia or magenta, whatever you want to call it, is also probably up, arguably flat year over year in terms of total truck visits, which is not that surprising, I don't think, for a lot of people. But If you look at some of the other big box retailers out there, you have Walmart, you have Target. So Walmart's in orange, Target is in blue, Home Depot is in green. These are all showing pretty strong downward movements from a year-over-year perspective.
Indeed, and then there's a couple reasons for this. Let's dive into it. So let's think about the business models of each of these retailers. So Amazon's business model, the predominance of volume that runs through Amazon's business, and this is less understood for most people.
Right.
The predominance of volume is not Amazon buyers sitting behind a desk ordering product like you would see at a Walmart or Target, where the buyers are legitimately ordering. They have a buyer for eggs, they have a buyer for these products for these consumers. You know, if you run a DTC, a retail store, a retail product, and you go and pitch, or pitching a Walmart buyer, Amazon's a little different. They have some of that, it's part of the core products, but a lot of Amazon's business is the platform. It's that platform business where they invite Amazon sellers to sell product. And I think what we're seeing in the Amazon data is a lot of this is organic growth of their network. You know, they've created a whole toolkit that enables small sellers to sell on Amazon. So I bought a business for my son. It's sort of a pet project. We bought this airplane model company. We're selling airplane models. Amazon is a provider. You can go on Amazon and buy a model, and we fulfill it here. And he gets the effort of having to put it in a box and all that fun stuff and ship it out. But we're an Amazon client. So I think what we're seeing in the Amazon chart is just the growth of Amazon's business model. I think we should put that one aside because it's hard to sort of draw some. I think the more interesting ones are Costco, Walmart, and Target.
Well, let's pull up Costco individually, and we'll hit that one first. So let's pull up the Costco.
Well, before we do that, I think can we go back to that chart real quick? I just want to point out something really, really clear.
Okay.
So that blue chart that you see, that blue line is Target. I want you to remember that. I want you to remember how far it fell. And I want you to look at the date, because this is going to come up. Everyone says, well, this is the woke mafia or the anti-woke mafia that's getting the head of Target. That's what everyone, when I posted this stuff on Twitter, it's like, well, they've sort of, they've done these things that offended some of their clients. Bud Light can empathize with, or at least relate to that. That isn't showing up in the data. Like maybe in June you see some of that, but that doesn't explain the massive drop.
Right.
This is an economic problem, and I would argue Target has never been really sort of embraced conservative politics. I don't know what my phone is. I have no idea what's going on.
He'll call you back.
I don't know what that is. It's like some weird alien or something.
Alien.
The anti-woke mafia is getting. So this is not the predominance of the drop. Like you can't explain that through sort of brand-specific issues. I think this is an economic problem. So let's pull up the Target chart. But I want you to keep that in mind. The blue chart is really important because it shows what we're seeing.
Okay, pull up the Target chart then. The Target chart, I think a lot of people, and this is going to be a different time frame here. The last one you just looked at was a year. This is going to be over the last couple of years, just to give you a little bit more context and perspective on the Target situation. See that big COVID boom happening there, and then there's kind of a big drop off.
Well, you had that big drop. That's seasonal. That's what happens when retailers stop ordering product for the fourth quarter. Yeah. That is not an unexpected drop. That is a normal drop. But what I think is really interesting about this, and I think it's very specific to Target's business, is think about the products that Target sells. Is they're going to skew heavier to consumer discretionary. Target is a premium retailer above Walmart. It doesn't have as big of a grocery store as what you see at Walmart and Costco. And so it caters the types of products that tend to be more expensive, higher priced, and more consumer discretionary. They're huge in things like home goods in terms of like toiletries and stuff that you have in your bathroom. The towel rack at Target's pretty extensive. They do stuff that tends to cater to women's preferences in store, and their market is up market to Walmart. Costco's predominance volume is grocery and consumer staples.
Right.
That's Costco. You go in there and you buy enough meat to feed an army.
It's also a discount if you buy in bulk.
It's a discount. Yeah. They don't really make a lot of money on retail. They make their money on their membership. But like you go in there and you're shopping, and you go in for a single steak, you're going to have to buy a whole box for a whole month.
Yeah, let's pull up the Costco chart. I think there's a big story there in the way that the shapes of these two charts
So it's not
really differ.
it's not dropping the way Target did.
Right.
Remember that. Like,
Everybody dropped
it
out
sort
of
of
COVID.
slowly
Yeah.
dropped down, but this is telling us the story of grocery.
Well, this looks to me more like a return to a normal
It does.
type route.
It definitely is telling us that grocery and consumer staples, it's sort of reverting back to those norms. It's bled off all that excess inventory. Remember, Costco is the retailer that went out and chartered its own container ship to get excess additional capacity. It's now returning back to us. But let's go look at the Walmart chart, because I think this is Walmart's business is really interesting because it is the largest grocer in America. Over half, I think 55% of Walmart's revenue is tied to grocery.
Right.
So, Target's is much less than that. I don't know the exact number, but it's much less than that. And what we're seeing here is this, it looks a little bit more violent in terms of direction, up and down.
Yeah.
But it's showing what you would normally expect. You've got the holiday, and then you have sort of what happened in July. So they've sort of burned a lot of that inventory off, but this looks more normal. You don't see this sort of brand collapse that you saw at Target. So Target had all this excess inventory. They built it, they burned it off, they've not returned back to it. Walmart is managing it a bit tighter, it looks like.
Right. So, I mean, the takeaway here, I think you're saying is we're entering an economic environment, just like we've seen in multiple recessionary states where people start buying, they trade back into that discount state of.
For sure, as you would. I mean, even Walmart on their public earnings have talked about how consumers that are in the upper end of the market, higher income consumers, are going to the store. It's an interesting thing that came out in their earnings report this morning, that the #1 growth category of Walmart's business is in the pharmaceutical area, and it's Ozempic. It is weight loss drugs. And that is driving, they don't make a lot of money on it, but it's driving people into the stores.
I think that's actually a hidden metaphor.
But does Americans need to lose weight?
No, because you see this chart here. Everybody got fat during the pandemic. And I'm not saying that in the way that they gained a bunch of weight, which obviously some of them gained more than they wanted to by buying Ozempic, but also
Or losing it, yeah.
we're in a period where we had this really bloated economic environment.
We did.
And now we're starting to come out of it with.
Well, we're out of it. And I think we're in a more normal thing. And I think the problem is, going back to the trucking market specifically, is that it does not feel that way. It does not feel that way because of the massive expansion in capacity. So if we go back to let's go back to OTVI for a minute, because I think this is a really interesting chart that I think we should point out, is in the OTVI chart, what you see, and you compare it, the green would be 2022, that orange line would be 2020, and the blue would be 2021.
Right.
If you look at where we are compared to 2019, we're up about 9 to 10%, maybe a little higher. And so that feels like things are better. That's why the economic data, the GDP numbers, growth is in excess of 4%.
Right.
That's why on an economic basis, the economy looks really robust. And the data would suggest that's the case. In the freight market, that's not the case.
Right.
And that's because of the amount of capacity that was added during the COVID economy. We added 25% more capacity today, or added during COVID, than we did pre-COVID. And that means you have a lot of excess that we have to burn through. The trucking industry needs to get on Ozempic. That's what needs to happen.
There we go.
The unfortunate reality is that there is no magic pill. There is nothing that this industry can take that's going to have the benefits and create a healthier market without bankruptcies and churn to capacity. Now, we know it's happening. We know it's happening. We're seeing bankruptcies. Yellow's helping the situation. We know it's happening with just not only the anecdotal data, but also some of the firm data. We know it's happening. I've talked to a company, people close to a company that is one of the large ELD providers in the space, really focuses on the small business market. I was told they were churning out $5 million of ARR a month because fleets were simply going out of business. And what was happening to their business model was they were having to actually in many ways, diversify away from trucking because the cyclicality was so significant. And if you think about that, if you're seeing a lot of capacity churn, and these are SMB carriers, is that the market is trying to correct.
Right.
The problem that we've got is the market simply cannot correct fast enough to give anyone any sense of promise about the second half, and that's what we're dealing with.
Yeah, so we have to hit rates because everybody wants to talk about rates, and I think this embodies exactly what you're talking about. I think, so you're looking at OTVI, it looks like from a standpoint of over 2019, 2018, 18 was a very strong year for freight, and we've grown 10% above that. So where is, the idea that capacity is too far above the demand level right now, obviously is squares. We saw the
tender projection. I mean,
we saw tender rejection rates.
People ask, what is the situation capacity? Right. How do you know it's not coming back? I said, tender projection rates are 3.5%.
They're not responding to this demand at all. So let's pull up NTIL. So this is going to be the spot rate, the National Truckload Index, excluding the estimated total cost of fuel. NTIL. So the white line, current year, 2019, they're in orange, and we are literally like dead even with it.
In terms of rate.
And that's
here is the danger, though, Zach.
Yeah.
And here's the thing that everyone needs to know, is yes, the rates have reverted back to 2019 levels. Not so bad. Except your rate cost per mile is up as much as 30 cents a mile. And that's without fuel.
Right.
You haven't factored in the cost of fuel to that.
2019 was a soft market.
It was the bloodbath of 2019. Yeah. There were more bankruptcies in 2019 than any point since 2008. It was a massively difficult market. We are back in the rate. And here's the second thing that no one's talking about is the rate's only half the equation. It's the lack of volume.
Right.
That is the bigger risk. It's not so much just the rate. Everyone gets caught up in the rates, and rightfully so. You should be caught up in the rates. But you also have to look at the volume of transactions. Now, the good news is that OTVI is up, but we're simply not seeing rejection rates high enough that indicates that carriers are getting fed.
Right.
They're simply not eating. They're on a diet. It is not a pill. It is simply the market is not feeding them.
Right.
The food does not taste good, and this has to get corrected. The only way it gets corrected is we see bankruptcies and we see companies turn. And that's the reality that we all have to accept, is this idea of a great purge, which Rachel Premack coined last year, has to take place before we see the capacity be reduced. In fact, Derek Lathers, the CEO of Werner Enterprises, one of the large truckload carriers, said, and he's right, I've had the same thoughts myself, is that carriers did much better and protected their balance sheet much better than what any of us expected. We expected the cycle for bankruptcies and a second bloodbath to have taken place by now. In 2022, we expect a lot of churn. It didn't happen. It is starting to happen. Yellow is, think about the bookend of 2019, that year that we saw just catastrophic conditions in trucking. New England Motor Freight was in January, at the end of January. A storied carrier that had been around almost 100 years filed bankruptcy. And then we ended the year with Celadon at the end of 2019 with one of the large truckload carriers that filed bankruptcy. Yellow potentially is that start of the great purge that we talk about, and it's bookending the start of the churn of capacity. And it may bookend with another large carrier at the end of it, we don't know. But we are certainly not at a point where the churning of capacity, the purging capacity has been significant enough to really provide any support. And all you have to look at is the two data points that you should care about in this, NTIL and OTRI.
Yeah. So let's talk about the contract to spot spread really fast. Contract v spot. So we know spot rates are down where they were in 2019. It looks like they've been kind of, stabilizing-ish over the summer. They're not dropping significantly anymore. Arguably may have found a floor to an extent. Doesn't mean that they can't get lower, but the contract v spot, and this is just the rates chart here. So this is fine too. The rates are still, the spread on this supports contract rates continuing to drop, or spot rates are going to have to come up. And we just talked about how OTRI does not support a spot market surge.
It doesn't support it. Look, let's just be fair. Spot rate, the OTRI data was at 2.5% in mid-May. So it has come up, a point. 100 basis points up. So it's up from where the bottoms of it. But 3.5% is near an all-time low. It's still, like, if this was a normal market, we would say that was the low. That was surprising to driver drop that bad. Having said that, you're right, is that there is no pressure. So look, ultimately, OTRI is telling us that the market is communicating that it is still, we're going to see contract rates still come down. I think one of the interesting things about spot, I want to talk about NTIL, is it has been trading in this the low end about $1.44, and I'm taking fuel out of it, to anywhere from $1.44 to $1.70 on the higher end of that range, but really in the $1.60 range. It's sort of the upper end of it right now. I think what the market's communicating, what the NTIL is communicating is, there is a bottom in the market, and spot rates will not go lower. Is basically what's communicated is, we're at this point where carriers have made a rational decision that if they lower the rates any further, they cannot survive that. And I think what we're seeing is, in collection, is that the market is communicating that this is the low end of the rate target. I don't think spot rates will get cheaper. They may go to $1.45, but I don't see a situation where spot rates are going to fall to $1 a mile. Right. They're just not. And I think we are at a point where this is probably the bottom of rates. And
spot rates.
Spot rates, correct. Yes, should be very clear, spot rates. And what is happening is the spot rate performance, and I've said this before, spot rate always pulls on contract. Right. If it's higher, it pulls it up. If it's down, it pulls it down. And I think what's happening now is that spot rate is continuing to place pressure on contract. And we're seeing that slowly grind, that contract rate is slowly grind down.
And the contract rate was slow this summer. It slowed down.
It did. The fall of it slowed down. I mean, look.
But is that out of bid season? Like, are we just out in a period where we normally?
I also think carriers are trying to hang on to some of those gains as much as they can. And I think what's happening is that a lot of this freight has moved into spot. And what carriers have sort of rationalized is that they don't want to lower their rates and their RFP bids too much, but they can be more aggressive at taking freight in the spot market. Normally, they wouldn't do that. Normally, they would want all of this stuff contracted. But I think there's a fear that if they lock in low contract rates, they're stuck with them, that they're being much more stubborn and sort of giving up some of the gains that they rightfully won during the COVID cycle. And I think they're very stubbornly trying to hold on to those gains. I think the question that everyone should be asking, we should point this out, is when are we going to see a turn in the rate environment? Is it going to happen in the second half of this year? Are we going to see a Q3, early Q4 peak? Are we going to see it to the point where it breaks out of this? Or do we have to wait till next year? And my answer is, I don't know. I don't. I think it would be disingenuous to say, this is the most opaque market I've ever seen. Right. It's the most confusing market I've ever seen. Stock markets at all-time highs. Trucking stocks in the midst of one of the most challenging markets, quoting the CEOs themselves, their stocks are near all-time highs.
And they're talking about revising lower.
A lot of the big public guys have come out and said they have revised their forecast, and their stocks are rallying. Look, I don't hate it. Yeah. Look, that's great. It's great that the market is being very forgiving to the freight market, because that usually doesn't happen. They usually get obliterated when they do this. That's a good thing. But I think what we're dealing with is a very opaque and weird market. And it's because you're dealing with record high interest rates, the housing market's incredibly strong, we're starting to come back. You're dealing with autos, it's just so much sort of noise. And I think the problem is that we don't know. But I tell you how, if I am a shipper right now, and we've seen this through a number of freight brokers and carriers and 3PLs, have introduced index-linked contracts, which are the function of, we both agree that rates are going to be volatile, shipper, carrier, and rather than us spending a lot of time trying to do like an RFP that one of us is going to be unhappy about in 6 months or a year, let's just agree to index our cost against a floating rate. And as the market turns up, we will simply allow that premium. I'll pay a higher premium. We could do it daily. We could do it monthly. I think we're seeing that. And I think, there's at least 24 companies that were using our track data to do that. I think we'll see more of that. And I think fundamentally with the volatility, it's funny because I go back in my life and I think about in a normal market, and I'm 44 years old, I've been around trucking my whole life, and normally what I see happen is that usually carriers have, in a 5-year period, they have like 1 year where they make bank. And then the pendulum swings. Since 2017, we have seen those cycles happen. We've had 5 or 6 of these cycles. Mm-hmm. And I think what's happening is that volatility is existing. It's just far more violent, and the time of which it happens is far more compressed. In fact, I've done a lot of studies on these sort of liquidity of networks. And what ends up happening, and I was reading an article years ago in the journal about Amazon's marketplace. What ends up happening is when you end up having a more liquid marketplace and more information in the marketplace, you actually have you have a lot more volatility. The market's more violent, it's more cyclical in it. And I think what's happened is over the last couple of years, there's been so much digitization. These brokers have taken a large share. There's been more information. We certainly have contributed to that. And I think what it's done is it's shortened the cycle. Right. The typical freight cycle is no longer measured in 3 to 5 years. It's measured in these sort of super quick cycles. Federal Reserve is not helping, or maybe they are, depends on your perspective. Right. But I think all of that stuff's playing out, and I think what we're seeing is the introduction of a much faster cycle than we've seen in the past. I don't know if that's welcome any news for anybody, but it does suggest that things are going to be more volatile in the future, and I don't think we're over it.
And that's why they created a fuel surcharge, something very similar to what you're talking about. So I want to make
pass
sure
those fuel costs on and index against Opus, and we're all in the money.
So I want to make sure that we get to some Q&A here, because I'm sure there is plenty, as there normally is. I'll toss it over. Marianne, let us have it.
Awesome. Thank you guys so much. To those of you listening in, if you've not already done so, you can submit those questions in the Q&A box in your console. We do have a few, so we will dive right in. The first question, what is the latest on flatbed index data available within the API?
The question was, do we have flatbed data within the API?
It's coming. It's coming.
Third quarter.
Third quarter. There we go.
We're not usually asked product questions.
No, right.
In this conversation, we do appreciate product questions.
I also didn't want to put product on the line.
Well, we got a studio audience here that may throw something at us.
All right, next question. With the crash of the peso versus the dollar, do you see a pullback on cross-border freight?
No, I think Zach talked about Laredo. I mean, Laredo is the strongest market, one of the strongest markets in the country. We're certainly not seeing a slowdown in cross-border freight. And again, cross-border could be referring to to Canada, not just Mexico. But as it relates to North America, north-south traffic, that sort of I-35 corridor, we're seeing the opposite. And look, currencies are a factor in all of this, as it always is. But really what drives the Canadian market is commodities. It's a commodity-driven market, a little bit of auto, a little bit of aerospace, but commodities really drive the predominance of the Canadian market. Commodities have been pretty strong. And it's interesting, even with, I think you should look at the WTI. You look at oil, I think it's telling a story that we should all know. China's economy is not robust. You would normally, and the oil traders have expected the WTI and oil prices to collapse in conjunction with China's collapse, because over the last couple of 2 decades, it's been China that's been consuming all the commodities. Commodity prices have actually stayed pretty robust. It's somebody else doing that. It's the American economy, and it's the American government building roads and building infrastructure that's keeping these prices high, and that's why oil has not collapsed in spite of the Chinese collapse.
Fair.
It's the American decade, probably
America. We'll call it America.
Does the trucking industry usually add capacity during times of high freight demand? And how does this differ, or how does this freight downturn differ?
Well, high freight demand, yes, they always add capacity. There's always an overcorrection. There's no barriers to entry. What happens is people who are driving for the carriers, the bigger carriers, even mid-sized carriers, are at the truck stops. They're reading things on FreightWaves. They're reading things through DAT's marketplace, on the Facebook groups, and they're saying, I'm making a salary or a pay per mile of 65 cents a mile as an employee driver, and this dude I met at the truck stop's making $4. I want some of that. And they end up going and starting their own trucking company. What happens is the big carriers are recruiting from outside the industry, and the high quality employee drivers are going and starting their own trucking company. And that's what we saw, is we saw a lot of the employee drivers go into the owner-operator market. It's never been easier to access freight through the spot market.
Right.
Load boards are a factor. Digital apps are a factor. Brokerage has proliferated over the last 2 decades. And so it's never been easier. There's no moat to keep carriers out of the industry. And so they just enter. This is a down cycle. Question was, is this, I got kind of confused on the question, but it's a down cycle. There is still new entrants entering the market. And so we are seeing, everyone's talking about the revocations leaving the industry, but there's still new participants entering. And what's happening is when you're working for a big trucking company and you're not getting a lot of dispatches and you're not able to support yourself, that in some ways is the push to go out and become your own boss. You're like, well, I've gone through 3 different trucking companies and they haven't done well. I've saved up enough money. I think a lot of drivers would say that's their dream,
right,
to be their own boss. And they've taken the leap to sort of do it now. So it isn't a perfect answer to say that it's one way in revocations. We're actually seeing new participants also enter the market at the same time.
Yeah, and I think everybody has to realize that that's a long decision process to say that I'm going to go and be an owner operator or be a truck driver or add capacity. That's a 6 to 9 month decision that you lock yourself into, and then once the market turned on a dime in March last year of 2022, and you're not just going to go back on that decision that you just made and committed all this financial time and effort into.
This is
even
life savings for people.
Yeah, even at a larger company, I used to make the budgets for some of these decisions to purchase trucks. That takes months of planning.
Well, if you've gone out and bought a truck, you're committed.
Yeah.
Yes, can you hand the keys back into, and this happens all the time.
But you don't want to do that right away.
But
you can't do that as quick as the market.
This is a big financial commitment. If I bought a truck, even if I'm not able to make payments, I still have made a down payment.
Right.
And I probably have serviced that note for some time. We're talking about, for a new entrepreneur, this is their life savings. Mm-hmm. This is their one shot at entrepreneurship. And it's hard for them to give that up. And I think we have to sort of recognize that's why it takes a while to hang on, and that's why it's not so quick.
Yeah, and the M&A environment has been pretty robust over the last bit, which is probably also giving life support to places a little bit.
All right, next question. How do you see carrier profitability and cash position changing over the next 12 to 18 months? And how will that impact investment in equipment like trucks and trailers?
Yeah, it's a good question. Carrier profitability is in many ways tied to contract rates. As contract rates continue to churn down, carrier profitability is under more pressure. And I'm talking fleets, I'm not talking owner-operators, specifically on the fleet side. So I think that's going to be a challenge as it comes to equipment prices. We now have 21,000 pieces of equipment that are being dumped on the market or will be in short-term order. A lot of that equipment is not well positioned for the over-the-road trucking market, but it is going to continue to drag down some of the data because they do have some over-the-road trucks and trailers and stuff that is a part of that yellow liquidation. There's going to be more bankruptcies. I think equipment values are going to continue to be under pressure for some time.
Yeah, I think there's not a lot more to add to that outside of the fact that the timing of this, just like it was slow for capacity to kind of react and add, it's probably going to have a little bit of a lag too towards the end.
Perfect. And next question, do you think container rates for ocean freight will increase like they did during COVID?
No.
That's done.
You have seen the peak of the container market probably in my lifetime. Mm-hmm. I think what we saw was just so much stimulus. I mean, it's like $6 trillion of government stimulus went into the U.S. economy, and every other country around the world also stimulated their economy. Mm-hmm. So we're talking, $9-10 trillion of liquidity. It all ends up in the American shores, by the way. Like when the UK stimulates the economy, a lot of that money, the smart money or the big money, flops into the U.S. market because it's the most liquid market, it's the most stable market. And so, a lot of that liquidity ended up here, and because that money was spent and consumed, it drove a lot of container consumption. The other thing to keep in mind is the container market The number of ships coming online to add to the container market over the next 2 years is at a record high. So we're also seeing, the other thing to keep in mind is we're also seeing a situation where this nearshoring fact is playing out, this move away from the Chinese concentration is favoring smaller ships versus the big ships. The big ships that are coming from China to the United States are going to continue to stay in more depressed rates than some of the sort of secondary lanes. And so I think we've seen peak container. You know, short of a major global conflict where you all of a sudden either have a massive amount of stimulus or you have a massive amount of capacity disruptions, i.e. a war, I can't see a scenario where container rates get to the levels that we saw during the COVID.
Yeah, I mean, that would be yet, I don't know if it's even a black swan event, but it's a, whatever's beyond black swan event would have to happen next. Not to say that it's not possible, but rates are moving up a little bit now, but I think most people would agree that that is just a short-lived situation.
It's a capacity. The ocean carriers have not, the top 10 ocean carriers have 90% market share.
Yeah.
They have more power over the container market than OPEC has over oil. OPEC only controls 45% of the oil supply. The top 10 carriers in the ocean control 90% of the capacity.
Right.
They can manage that a lot tighter, and that's what we're seeing is they're doing blank sailings, they're slowing the ships down, they're canceling voyages altogether. They're pulling capacity and recycling some of that steel that they can put into other markets. So we're seeing a situation where some of the older vessels are coming off, but they're still adding a lot of capacity. So I would, look, if I were in the ocean market, you probably are getting a fair market rate right now for what you'll be getting for some period of time. The ocean carriers are going to protect the floor to some degree, but I don't see a situation where you're going to be paying $20,000 a TEU.
All right, and I think we have time for one more here. How do you see an uptick in freight fraud affecting the way freight is being tendered and moved in the future if fraud continues to increase?
It's a great question. It's something I've been thinking a lot about. We're actually going to dive into this at F3. We've got a couple of sessions on freight fraud and load board fraud specifically. And F3 is in November. We invite you to come out. Zach is going to be here. We're going to do the State of Freight live on stage. I've heard of a live audience, a much bigger audience. Right. So we invite you. That's in November. That is our event that we're going to dive into. We're going to certainly talk a lot about freight fraud. Freight fraud's something I feel pretty passionate about, frankly, because it is something that puts a lot of the business at risk. The people that are the most vulnerable to load board fraud specifically are small independent operators. And the reason we're seeing it accelerate is two fundamental problems, or reasons. One is carriers are more desperate to take freight, so they're trying to move their trucks and they're being less careful. And the second reason is during the COVID cycle, there was a proliferation and growth of a lot of offshore call centers and people entering the freight brokerage industry to serve all this volume. Well, now that's stopped and slowed, a lot of the people have basically now know how the market works and have found an attractive way to double broker and do other kinds of freight fraud. It is proliferating. It is a major crisis. The industry must step up. The only two companies that have the power to do anything about it at scale are Truckstop and DAT. They must take responsibility for this and hit this head on. We are starting to see both DAT and Truckstop talk about collaborating with the FBI. I think that's fantastic. There needs to be more. They are the only parties that can regulate it. If they don't do it, to answer the question, their business models will be at risk. Because if I'm a shipper, I don't want my freight on a load board. I'm okay putting it onto a broker load board that I know is pre-vetted, but I am not going to put it onto an open marketplace. And I think that is that's something they need to answer for. The same way MasterCard and Visa have had to fight fraud in their networks, DAT and Truckstop have to do the same. And I hope that they do. And it's something that I think we need to continue to put a light on because it's an important topic.
There you go.
Excellent. Well, everyone, that is all of the time that we have for today. So Craig and Zach, thanks as always for being here and sharing your insights with us. Thank you to our friends at Prologis again for partnering with us to bring you today's presentation. And finally, thank you to our audience for your participation and amazing questions. If we were not able to answer your question live, our team is happy to connect directly. Our State of Freight webinar series continues next month, so mark your calendars for Thursday, September 28th at 2 p.m. Eastern, and be sure to look for that invitation in your inbox very soon. Thanks so much for being here, and we hope you'll make plans to join us again next month.